Your business is a bucket with holes. You spend all day pouring revenue in from the top, sales calls, funnels, ads, product launches, while money quietly leaks out the bottom as costs, suppliers, payroll, software, refunds, and tax. Most owners try to fill faster. The smarter ones first plug the biggest holes. The math is painfully simple. If your operating margin is 20%, you need $5 of new revenue to add $1 of profit. Or you can reduce your tax bill by a single dollar, and that dollar drops straight to the bottom line. A well-run tax strategy that finds $100,000 of lawful savings is the same as adding $500,000 of new sales at that margin. This is why seasoned CFOs quietly obsess over tax. It's the cheapest growth lever in the building. To use that lever correctly, you need two ideas in your pocket. Your marginal rate is the rate on your next dollar of income, the top bracket you sit in. Your effective rate is what you truly paid overall, total tax divided by total taxable income. People panic about marginal rates, but businesses live and die by effective rates. Your mission is to narrow the gap between those two numbers, legally, by changing what counts as income when it lands and where it sits on your ledger. Your marginal rate is the rate on your next dollar of income, the top bracket you sit in. Your effective rate is what you truly paid overall, total tax divided by total taxable income. People panic about marginal rates, but businesses live and die by effective rates. Your mission is to narrow the gap between those two numbers, legally, by changing what counts as income when it lands and where it sits on your ledger. Start by getting a baseline. Open last year's return and your management accounts. Look at total revenue, pre-tax profit, and total tax across federal or national, state or local, payroll, and any foreign income taxes. Divide total tax by pre-tax profit, and you'll see your effective rate in black and white. Then ask a ruthless question. If you had known those numbers on January 1st last year, what would you have changed? Entity, compensation, timing, geography. To cut that effective rate by 2 to 5 percentage points? 2 to 5 points sounds small until you remember that on $1 million of profit, it's $20,000 to $50,000 of pure margin. All meaningful tax strategy reduces to 4 families of moves. Timing is the first family. You move income and expenses across calendar lines so you're taxed when it's cheapest. You push revenue recognition into a lower income year if your contracts and rules allow it, and you accelerate deductions you were going to incur anyway into a high income year. You choose depreciation methods and capitalization thresholds intentionally instead of accepting defaults. You write a short capitalization policy so small gear can be expensed cleanly. And if you carry inventory, you control your method and your counts before December so you don't discover an expensive surprise in March. Character is the second family. Not all dollars are taxed the same. Wages, dividends, long-term gains, qualified dividends, pass-through income, royalties, and credits all wear different jerseys. Moving a dollar from ordinary income into a capital gains-like lane, or converting a deduction into a credit when the law allows, changes the rate on that dollar dramatically. Credits often beat deductions because deductions shrink the income that gets taxed, while credits slice the tax itself. Location is the third family. Taxes differ by state, city, and country. Where the work is done, where decisions are made, where intellectual property lives, and where customers sit all matter. In the United States, a clean state footprint plan can add or erase 5 figures quickly. Internationally, permanent establishment and transfer pricing turn unpredictable audits into predictable margins. You do not have to be a multinational to benefit from this discipline. You only have to know where you are creating a taxable presence and document pricing between related parties as if you were strangers. Entity and compensation make the fourth family. The wrapper you choose, sole proprietorship, partnership, LLC, S Corp, C Corp, or foreign equivalents, and how you pay owners and key team members, salary, bonus, distributions, options, determine which taxes hit at which rates. The wrong wrapper is like running a marathon in hiking boots. You will finish, but you will bleed profit the whole way. Let's make it practical by dropping into business realities you'll recognize. Imagine a scrappy service shop with a founder and a small team. The cost base is people and software. The quickest wins come from entity and compensation. Many owners operating as sole proprietors or single-member LLCs pay full freight on every dollar of profit. Recutting that profit into a reasonable salary plus distributions, where allowed, can reduce payroll taxes on the distribution slice while preserving retirement contributions and benefits. Layer a retirement plan like a solo 401k or SEP, and you convert cash into owner compensation with a deduction today and tax deferral tomorrow. Time your software renewals and training you already need into strong years, but resist creating deductions for the sake of deductions. Be honest about state nexus as your team spreads, because registering early is cheaper than penalties and back filings later. Now picture a product brand fueled by inventory, ads, and fulfillment. Your tax profit lives inside inventory and ad spend. Inventory accounting decides when purchases become deductible cost of goods sold. Accurate counts are money. Count sheets you sign and keep are money you can point to. If you invest in packaging, dies, molds, or production equipment, accelerated depreciation and expensing can move the effective rate in a single year. Credits for domestic production or energy upgrades often lie ignored in the mid-market. Marketplaces may collect sales tax for you, but income tax nexus and filing footprints still exist. Model the state map deliberately. Cross a border, and you'll design customs and VAT so you do not pay tax in places where you can't claim credits. That isn't clever, it's survival. Consider an agency or studio with project work, deposits, and work in progress. The enemy is sloppy revenue recognition and messy contractor classification. Deposits for future work belong on the balance sheet until you deliver, not in revenue, because matching revenue and costs smooths income spikes that push you into higher brackets one year and lower brackets the next. Contractors who look like employees can vaporize savings through penalties. Clean contracts, tax forms, and a firm no paperwork, no pay rule protect you better than any pep talk ever will. If you genuinely do experimental development for client tech, track hypotheses, sprints, and outcomes like a scientist, so R&D credits are real, not aspirational. A scaling SaaS looks different again. Recurring revenue, capitalized development, and equity compensation drive the story. Capitalize qualifying development costs and amortize intelligently, then pair that with R&D credits to reduce current tax while you build. Think globally earlier than your instincts suggest. Decide where developers sit, where intellectual property will be located, and which country's incentive landscape and treaty network supports your roadmap. Equity comp throws long shadows. The way you draft option plans, the vesting, and elections like 83B can decide whether future upside is ordinary income or capital gain. This is where the marginal versus effective distinction becomes a steering wheel. Your marginal rate next year might look high, while your effective rate across a 5-year arc can be tamed by choosing the right lanes now. It helps to revisit deductions and credits with real money in mind. A deduction reduces the income being taxed. If your marginal rate is 30%, a $10,000 deduction saves roughly $3,000. A credit reduces tax dollar for dollar. A $10,000 credit saves $10,000. That is why a smaller credit can outrun a larger deduction, and why documentation for credits is worth the effort. Documentation is cheaper than tax. Business owners eventually ask the wrapper question: should you be an LLC, an S corp, or a C corp, or a local equivalent abroad? There isn't a single winner. If you plan to distribute most profits annually and you qualify, a pass-through vehicle often minimizes double taxation and lets you tune salary and distributions. If you will reinvest heavily, plan to raise capital, or aim for a stock sale exit, a C Corp may be the right road despite potential double taxation on dividends because investor norms, equity compensation, and, in some jurisdictions, powerful exit relief make the math work. The adult move is to run 5-year models for your real plan and compare after-tax cash under each wrapper, including owner compensation and benefits. Cadence matters more than clever ideas. Profit-driving tax strategy is not annual, it is quarterly. Close the books every month for 45 minutes and run a 90-minute tax sprint each quarter. The early year is where you lock entity and compensation choices. Refresh your capitalization policy in writing and commit to retirement contributions with a simple profit sweep rule. The middle of the year is where you check state and international footprints and register where you have created nexus rather than pretending you haven't. Late summer is when you run a projection with your accountant while there is still time to decide. If you are ahead of plan, you choose which deductions to accelerate and which invoices to invoice in January instead of December within the rules and actual delivery. If you are behind, you avoid creating deductions you do not need. The final quarter is where you harvest gains and losses intentionally, complete fixed asset purchases you had already planned, and finalize credits that require calendar year spends or certifications. The difference between ordering on December 28 and January 3rd can be 5 figures. None of this should feel like a horror film because the law provides lanes you can drive quickly if your story matches your paperwork. 3 habits do more to lower your effective rate than any exotic tactic. Write down the business purpose for unusual transactions on the day you do them, not months later. Collect exactly the documents credits require, from invoices and payroll registers to experiment logs and energy certificates. Reconcile your books to your return every year so your numbers tell one story. The ugliest audits are not about rates, they are about missing proof and mismatched narratives. Let's translate the theory into a mini movie you can feel. Imagine you run a $4 million revenue agency at a 15% operating margin, $600,000 of pre-tax profit. Last year, your total tax was $180,000, a 30% effective rate. You decide tax is a profit center and change a handful of things on January 1st. You move from a sole prop to a structure that pays you a market salary and the rest is distributions where permitted, saving around $20,000 of payroll taxes. You implement a retirement plan and defer $66,000 between employee and employer buckets, trimming roughly $20,000 of current tax. You adopt a written capitalization policy and properly expense small gear, worth a few $1,000s across the year. You formalize real R&D tracking for your software work and secure a $25,000 credit. You run a third quarter projection, see that you are ahead, and bring forward $30,000 of training and software you were going to buy anyway, cutting roughly $9,000 of tax. In a single year, you move nearly $80,000 from tax expense to profit. At a 20% margin, that is the same as adding $395,000 of new revenue without buying a single extra click. If your world is pallets and ports rather than pitch decks and sprints, the math still smiles. A multi-state product brand maps nexus, stops overfiling where marketplaces already collect sales tax, fixes inventory counts and cost methods so taxable income spikes stop pushing the business into high brackets randomly, claims legitimate domestic production or energy efficiency credits for plant upgrades, and sets a retirement plan that rewards key staff and owners while reducing tax. In a $10 to $20 million shop, the result is often $50,000 to $150,000 of real savings. At a 10% margin, that feels like $500,000 to $1.5 million of sales. All smart decisions run through the same two questions. What is the marginal rate on the next dollar I am reducing? And how will this change my overall effective rate this year and next? Accelerating $100,000 of deductions into a year with a 24% marginal rate saves $24,000 today. If that move also lowers your bracket next year when you expect slower income, perhaps you would rather save the deduction for the later, higher rate year. If this year is your peak and next year you will reset, you take the deduction now and enjoy the lower effective rate while it counts. You cannot steer a car by staring out the rear window. Midpoint projections let you look through the windshield. Two myths deserve retirement. The first is the idea that your accountant will fix this at tax time. Compliance is history. Strategy is calendar year. You meet your accountant when choices still exist, not after the doors are locked. The second is the fear that planning triggers audits. Audits find mismatches and missing proof, not businesses driving in the lanes with tidy files. Plan boldly and document cleanly, and you will sleep. Not every tactic fits every business, but every business can run the framework. Establish your baseline effective rate. Choose entity and compensation intentionally. Schedule quarterly tax sprints. Claim credits you genuinely qualify for, and gather their paperwork when the work happens, not later. Match revenue and expenses so your story is smooth rather than spiky. Treat your state and international footprint like you mean it. The return on this discipline is wild because you are raising net profit without buying growth. Imagine opening your P&L next spring and seeing a wonderfully boring line, tax expense, down by 15%. Nothing else moves that fast. Your runway lengthens. Your valuation multiple inches up because buyers prize predictable after-tax cash flow. Your team's bonus pool looks less fragile. And you did it by moving tax from afterthought to profit center, measured and managed like sales, operations, and product.